Imagine you manage a modern manufacturing facility. Your operations run entirely on electricity, your site is clean, and you don't burn a single drop of fossil fuel on the premises. Yet, on paper, your organization's carbon footprint is enormous. Take a look at a facility like this. Hundreds of machines spinning yarn and processing fabric, driven purely by electric motors. Looking strictly within these four walls, the immediate climate impact appears to be zero. But those machines are spinning cotton, and producing that cotton requires heavy diesel tractors plowing fields hundreds of miles away. This is the reality of modern corporate carbon accounting. Your environmental footprint is not limited to what you physically combust on site. It includes what you directly control, the energy you purchase, and the supply chain you influence. To standardize how we measure this global web of emissions, the world relies on the Greenhouse Gas Protocol. This is the foundational framework that every major ESG reporting standard builds upon. This visual shows the core equation of the protocol. It breaks an organization's climate liability into three categories. Your total carbon footprint equals Scope 1 plus Scope 2 plus Scope 3. The final metric is calculated in CO2 equivalent, or CO2e. These three distinct boundaries provide a standardized way to categorize every gram of CO2 an organization touches, ensuring the final footprint covers the full scope of its operations. We start with Scope 1. These are direct emissions originating specifically from sources the organization explicitly owns or controls. To map this, let's look at this 3D model of a textile mill in Faisalabad. We draw a strict physical boundary, this solid orange line, around the perimeter of the facility itself. Anything inside this line that directly combusts fuel belongs to Scope 1. If this mill uses on-site gas boilers or furnaces to generate heat for the manufacturing process, those emissions are counted right here. In Pakistan, local infrastructure challenges add another major layer. When load shedding hits, the facility relies on backup diesel generators. Because the company owns those generators and controls the fuel being burned on their property, those emissions are entirely Scope 1. This boundary of control also extends to mobile assets. If the mill owns a fleet of delivery trucks running on CNG or diesel, that orange boundary stretches to encapsulate them wherever they travel. However, if an employee drives their personal car to work, that doesn't count here. Scope 1 is strictly about corporate financial and operational control. If your company turns the key or directly ignites the fuel, you own the emissions. That is your Scope 1 liability. Next is Scope 2. This category covers indirect emissions tied directly to purchased electricity, steam, heating, or cooling. Consider a commercial bank headquartered in a major hub like Karachi. This skyscraper requires massive electricity for lighting, server farms, and air conditioning. The building isn't burning fuel to keep lights on, meaning its Scope 1 footprint is essentially zero. But pulling that energy from the grid legally tethers the bank to an off-site generation source. That electricity physically originates here. The moment the bank purchases power, they are financially authorizing the combustion happening at thermal power plants miles away. This chart details Pakistan's specific national energy grid mix. As you can see, the grid relies on a precise blend of natural gas, furnace oil, hydro, and coal. Because not all electricity carries the same carbon penalty, the specific ratio of fossil fuels to renewables in this mix dictates the exact multiplier applied to every single kilowatt-hour the bank buys. This is known as the grid emission factor. Scope 2 accounts for the emissions you financially authorize. It bridges the gap between a clean corporate office and the distant infrastructure powering it. Scope 3 captures all other indirect emissions occurring across your entire value chain, outside of your Scope 2 energy procurement. For the vast majority of companies, this is the largest, most data-heavy, and most difficult metric to measure accurately. This diagram maps out a global supply chain to show how Scope 3 is structurally divided. We split these emissions into upstream sourcing activities on one side and downstream distribution activities on the other. Tracing the upstream path for our textile exporter, we follow this line back to the raw origin. The carbon footprint of the independent agricultural operations farming the cotton is immediately added to the exporter's ledger. Moving forward, independent ginning and dyeing operations stack additional embedded carbon into the fabric before it ever reaches the final manufacturing floor. This upstream category scales up rapidly, capturing everything from purchased goods and operational waste to employee commuting and business travel. Once the finished product leaves the organization's physical control, we pivot to downstream emissions. This is where global logistics become a primary liability. Moving export goods by sea freight to markets in the EU or the US requires massive, diesel-heavy port infrastructure and shipping vessels. The downstream frontier even extends to the end user. The energy consumed by the customer washing the garment, wearing it, and eventually disposing of it in a landfill is all categorized under Scope 3. Mapping your Scope 3 proves you are accountable for your total economic footprint. You own a fraction of the emissions of every single supplier you pay and every customer you supply. In today's global market, documenting Scopes 1, 2, and 3 is a mandatory prerequisite for maintaining access to international supply chains. The European Union's Carbon Border Adjustment Mechanism, or CBAM, presents a hard regulatory threat to regional exporters. If a Pakistani manufacturer ships to the EU without proper carbon documentation, it alerts authorities and triggers immediate financial tariffs. Furthermore, international retail brands use Scope 3 reporting as a baseline filter. Without it, they reject contracts and move to compliant suppliers. This beta pressure applies domestically as well, particularly within corporate finance. The state bank's Green Banking Guidelines increasingly mandate that commercial lenders evaluate a borrower's total greenhouse gas footprint before approving new capital. Combining the data from direct operations, energy procurement, and the wider value chain produces the definitive total required for official corporate disclosure. Audit your own operations today to identify your largest data blind spot. Which scope is the hardest to measure in your industry? Let us know in the comments below. And in our next module, we'll break down the specific mathematical equations you need to actually calculate these liabilities.